The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and a very warm welcome to India Ratings webinar on the infrastructure sector. I am Saranya Shetty, Manager Corporate Communications and Investor Relations, and your host for this webinar. To join today, Siva Subramaniam, the Associate Director for the Infrastructure, will be joining us to make the presentation. He would also have Venkat Rajaraman, the Head for Infrastructure Group, joining him. As you know, a detailed report is available on our website. I hope you've received a copy of the same. In case you haven't, you could please log on to our website and download it from there. Just before we start the session, you may post questions for our panelists today in the dialog box given. We will be answering them once the presentation is done with. So without any further delay, I'd like to hand over the session to Siva. Siva, over to you.
Thank you. Thanks, Saranya. Thanks, everyone. Good afternoon, everyone. We'll go ahead with the presentation. As a part of yearly exercise, we release infrastructure outlook. So this year is also another one more year of it. The overall agenda is we'll cover the sector outlook and also the key emerging financing trends in the sector and how the ratings have moved, rating outlooks have moved over the last 3 years specifically. And we cover each of the sector individually, which are toll roads, annuity projects, PPP, airports, seaports, and coal-based thermal power plants. Additionally, we will also cover the renewables. And finally, we would also discuss in brief what are the trigger points for the change in outlooks. So, firstly on the overall sector outlook. The sector outlook is placed on negative to stable category. Earlier in 2015 financial year, we have maintained it on negative outlook. So the change from negative to stable is broadly based on 4 or 5 parameters. One of them is the policy measures which the government has undertaken during the calendar year 2014 specifically, on several accounts, not restricted to specific sectors. So the sector as a whole has seen a slew of reforms from the government, and this had impacted the sector both positively, and also it would gradually also start impacting the sector. So this measures until now had given some positive impact specifically on certain areas, and some of them we would see the impact would pan out over the next financial year. So this, as of now, this is being both positive as well as a kind of a mixed impact on the sector. And the second key element is the private capital. Over the financial year 2015, we have noted that the response for the biddings for BOT concessions had been on decline specifically. Consequently, the government is trying to move away from the well-thought PPP model to a EPC cash-based contracts model. So there is a dwindling interest as far as private players are concerned. Hence the private capital is declining. Private capital is a cause for concern for the sector. And the other points which are critical for the sector is the thermal power plants, which had been facing a lot of issues, have been grappling with several issues, notwithstanding the coal auctions which had come out recently on a judicial based policy framework. Judicial process was an outcome of the judicial process. The plants, or say the power project as a whole, has been under severe stress during the calendar year 2014. Toll roads had been once again on facing a severe stress. We will capture all of the stress points as well as the points which are in favor of each of the sectors in the subsequent slides. These are broadly the aspects which we will cover now. And airports and ports have exhibited a very strong throughput volumes. Ports, especially throughput volumes, and airports, the employments have gone up substantially during 2015. So those two sectors are being on a stable platform. And another positive factor is many of the states have supported the renewables. Hence, the sector renewable is adding the push from the state as well as from the central government for the renewables is boding well for the sector. The key emerging trends as far as the sector is concerned, one is, we would like to classify this into three broad categories. One is the change in the lending norms. This is consequent to the 5/25 structure majorly being announced by the RBI, the regulator. As a result, many of the projects, the lenders are volunteering to lend to the projects in a very stretched amortization schedules are being given to the project. So that is adding some cushion. But that being said, the project, or say the loans, would be refinanced every 5 to 7 years of period. So that is that risk continues to be there. So the amortization schedule, which were compressed earlier, had now been stretched, giving some breathing space to the projects. So that is one positive factor which is being seen in the fag end of calendar year 2014 and in the beginning of 2015 as well. And the second most critical point as far as the broad sector is concerned is the investors' interest. Several projects were up for sale during the last year, and the investors have been cherry picking this project specifically on the account of the economic value which these projects would bring into the investors, and also they also look at another key element is the interest, or say how far the projects are being, whether it's a mature toll road project, whether it's a matured annuity project. So the status of the project also plays a key role in the selection of projects by the investors. The third element is the capital market access. The projects, especially on the road annuity availability-based road projects, have seen this is being migrating from a fixed cost rate of interest to the from the variable cost of interest to the fixed cost rate of interest. So they're trying to tap the capital markets. That is gradually upticking as well. There are a flurry of capital markets which we could see in the next financial year. So these broad trends are emerging as far as the sector as a whole is concerned. And moving from that, this is how the sector has changed over 14, 15, and 16. With an exception of say the seaports, the rest of the sectors are exhibiting a similar sentiments in 2016 as well. The seaports, which we have rated in the last financial year, have exhibited a very strong performance, which we'll capture in the subsequent slides. See, the toll road is the next major sector which we would be talking about. We had maintained a negative outlook on this, broadly based on the basis of following factors. One is the recovery of traffic is going to be stretched because this is stemming from a point that from the following points. One is the industrial growth. Industrial growth has been volatile during the last 4-5 quarters. Consequently, the traffic recovery is also not not up to the expectations of the management. And another critical factor which kind of offset, in fact, mitigated the revenue growth mitigated the traffic underperformance was the inflation. Inflation of late had been inching closer to the negative negative territory. Consequently, the strength or the project which the projects derived basically from the negative from the inflation had been not being passed on now. So the traffic underperformance was more or less mitigated to an extent by the inflation. That trend is unlikely to come in the second quarter, or say second quarter of the financial year 2016. So only when the inflation starts picking up, these projects which were severely affected by the traffic underperformance would be able to recover from their existing estimates. So that is a key element. And in addition to that, many of the projects have been substantially burdened with or laden with the negative grants which the projects have quoted during the bidding stage. So the huge negative grants has been sticking as a drag on the project's for cash flows, and also the other factor is the consolidation, which was kind of expected during the beginning of the next previous financial year did not happen or did not translate that quickly. Consequently, the consolidations were very slow, and we expect the consolidation trend to be continue in 2016 as well. This also would be broadly based on how the traffic performances are playing out on the dynamics of the project, as well as the other benefits which the project would receive on account of deferment of premium which NHAI had given to several projects during the last calendar year. So these would play a critical role, and sorry. So these would play a critical role, and another key element of what we are noticing in the road sector is many of the projects are moving from the operational phase to the first life cycle maintenance phase. So until now, the operation cost had not severely impacted because the cash flows were adequate, and also there was some support forthcoming from the sponsors. But these were on the basis of assumption on the assumption that the traffic performance would gradually improve. But since many of these projects are moving to the first major maintenance cycle, they would, in the absence of strong traffic recovery, the support has to come from either a sponsor or through any other source, any forms in the form of debt. So if these sources are not forthcoming, then the project would have to undergo a severe stress that could also impact their debt servicing coverage matrices. So these trends in fact continue to constrain the sector, and consequently the negative outlook is placed on the toll road. And moving to the annuity-based project, this is being retained on a stable outlook, primarily because of three accounts. One is stable and a very steady and a predictable cash flows are there as far as these availability-based projects are concerned. And the markets are seeing some of the deals, specifically this with the matured annuity roads which have received 3 or 4 annuities, and also subsequently many annuities are being trying to move from the variable cost of debt to the fixed cost of debt. So the players are substituting their variable cost with the fixed cost, which would positively impact the cash flows. But that being said, the key critical element is some of those projects are being re-geared to an extent that to advance equity to the parent company. So if there is going to be a substantial re-gearing, this would could affect their existing credit profile. And we also note that the substitution happens not only at the high categories, or say high A categories or high AA categories. It is across the categories. So several buckets, risk bucket portfolios, or say several risk bucket projects are trying to tap the capital markets. And as far as moving from that to a PPP airports are concerned, there are few strengths which support the stable outlook. Majorly, it is coming from the enplanements. There's a very strong enplanements which are being seen across all the private airports, and increasing air freight cargo is also another critical element which is supporting the stable outlook. And also we note that the 3 of the private airports which we rate are showing improvements not only in their aero revenues but also in non-aero revenues. Traffic performance, or say PAX, has impacted benefited the non-aero revenue component during the financial 2010 to 2014 specifically, and there's a very strong underlying demand for air travel, which is placing the non-aero revenue growth also on a positive zone. What is hampering, or say what is constraining the outlook or the many of the airports is that there is a financial stress which is emanating from the airlines a delay in the payment of their dues or their share to the respective airports. We also note that many of in the 3 of the airports which we rate, the substantial portion has to come from Air India. So that, and notwithstanding that, the airports have managed to ride over this liquidity stress either by opting for working capital or by efficiently managing their non-aero revenues, or say the revenues from the revenue real estate monetization. So that had being a kind of being a measure which these airports have undertaken to tide over the liquidity stress. So on the other side is what we have captured, how these airports respectively have crossed, or their recovery is quite substantial as far as their peak traffic is concerned. Many of the airports have performed exceedingly well during the financial year 2014 and 15 respectively. So these factors have supported the stable outlook. And moving to the seaports, this was the seaports had a stable to negative outlook last year. This is being now revised to stable outlook, which reflects broadly the sentiments the non-major ports are doing, especially on the cargo throughput volumes. The non-major ports throughput volumes are substantial, and during the last 3 years we could see that the non-major ports are capturing a substantial market share from, or I would say, snatching it away from the major ports. So that is what this chart in the presentation reflects. And another key factor here is the expected capacity additions which are coming from the major ports are to kind of these capacity expansions are majorly undertaken to kind of overcome the deficiencies which these major ports are facing because of the very high turnover which has been seen in these ports. So this should positively impact, but if you look at the numbers, FY15, it is not, the capacity addition is not substantial. So in post FY15 and FY16 is also just 100, closer to 100 MTPS, that's what's being seen. So post FY16 is what the major capex would fructify and would result in the capacity handling as far as the major ports are concerned. So non-major ports outpacing the major ports is being what is being noted. And one peculiar aspect for the fresh or the greenfield airports is that they have large greenfield airports is that they have a diverse cargo mix, and consequently they were able to tide over if there are some revenue volatility which is coming from, say, commodity embargoes out there. So the large greenfield airports have tied up with there are definitive long-term contracts with the industry players or from the hinterland industries. Consequently, even if there are some volatility, they have tried to manage it efficiently. Hence, the credit profile has remained more or less on the same platform. And another critical factor which has supported these greenfield airports are the evacuation infrastructure, internal as well as once again externally. Critical elements for the ports are internal evacuation system as well as the external evacuation. Many large greenfield airports have very good connectivity as far as NH roads are concerned, and even the railways are being helpful in evacuating their cargo. So that had aided them to maintain their credit profile stable. And moving from ports to the thermal plants, the outlook remains as a negative on the negative platform, primarily because of there are several issues these power plants are facing. Many of them includes, one of them is they have a very less stock as far as fuel is concerned. Consequently, these plants are operating at a critical levels, and the offtake risk continues to be there. The counterparty, the government's initiative to restructure the DISCOMs had not paid off in a short span of time. So it would take some more time to it would take some more time to translate that into the credit profile or say of the generation units. But what we have noted is, excluding the coal thermal plants, the payments to renewables are concerned, it's being prompt. So I'll say the receivable days have been decreasing relatively compared to the financial year 2014. So offtake risk continues to be there. Although discoms are trying to come out with annual tariff order revisions, this hasn't with many of the discoms it is not being happening on a regular basis. So that risk continues to be there. International coal prices have fallen, and consequently the impact on the projects have been on a positive note. And what we also understand is that the international coal is going to be imminent. Many of the plants cannot avoid importing coal because there are issues with mining coal internally. So the international coal is no longer a choice. It is going to be an imminent factor for many of the thermal power plants. And very few case one bidding has happened in last year. This trend is likely to continue, and when this offtake risk kind of gets offsetted to an extent because of due to the change in the credit profile, this should also gradually uptick in the next financial year, but not in the immediate in the near term, in fact. And projects which had faced the stabilization risks have tried to overcome that, and projects which are migrating from the construction phase to operation phase continues to grapple with issues like as far as environmental clearance, as well as also as far as the getting the PCODs are concerned. So those stabilization risk aspects continue to be there as far as thermal projects are concerned. And one key element which is being noted in the power sector is there are quite a few foreign investors have evinced their interest in buying out plants which are on the coastal belt, or closer to the coastal, where they can import coal much easier. So this is a trend which we had seen during last financial year. So that's a silver line, and acquisition will continue in the next financial year as well. Broadly, the power supply is inching closer to the reported demand. But a caveat here is the industrial activity did not pick up to a greater extent during the last fiscal year. So consequently, this may not be the right reflection of the demand. But nevertheless, the power supply inching closer to the demand is a factor which has played a positive platform as far as the sector is concerned. So that is on the thermal power. And as far as renewables are concerned, wind, most of the plants have exhibited performance on line with the wind studies. Construction and completion risk are relatively low for these projects, and government's must-run status had to an extent mitigated the demand risk as far as these projects are concerned. As I mentioned earlier, the receivable days from the counterparties have been falling consistently, so that is another supporting factor as far as the credit profile of these wind projects are concerned. And solar, there are support once again forthcoming from the government, bringing back the accelerated depreciation and also removing the anti-dumping duties as far as importing the equipments are concerned, have added strength to the sector. And the dependability on irradiation studies is critical, and the reliability is gradually picking up. But that being said, the lack of enforcement as far as the solar renewable power certificates are concerned, this is a matter of concern. But what we understand is when things starts improving, especially when solar picks up some momentum, this would be also enforced by the government. So that is kind of offsetting the initial teething issues. So critical element here again is the resource forecast study, which is crucial for the rating stability, and that would determine the future rating movements as well. And what would change the outlook? Better economic fundamentals, the growth, macroeconomic fundamentals like growth and inflation would play a critical role, and if there are the policy interventions have been happening in the sector for a very long time. So if this has to be followed out with rigorous on-ground actions. So if that is being taken care of and some projects are trying to re-engineer their financial structure. So with all of this playing favorably as far as the projects are concerned, and some interest coming from investor, would gradually change the outlook of the sector from the current negative to stable to a more stable platform. So that is all from my side, and we are open for questions.
All right, thank you so much, Shiva. As discussed earlier, I would request you please post your questions for Shiva. We already have a few here. The first one is from Mr. Surat Singh. The hybrid annuity model which is being discussed, how much that is going to help the construction of roads under BOT? Won't it result in only few builders cornering all the projects which can fund equity and also enabling them for bigger chunk of the projects on offer?
As far as the model is concerned, it is a welcome change, because many of the projects have been saddled with huge premiums, and their inability, or say the aggressive forecast, had hampered them. So this is a welcome change, and had that been the case, the cornering aspect is concerned, had that been the case, many of the large players who are already there in the market should have cornered by now. But the point here is the screening is going to be done broadly on their strength as well as on their technical abilities. So I think that as far as cornering is concerned, it is going to be a difficult aspect. Venkat would also like to add.
Hello.
Yeah.
Hi Venkat, yeah, we can hear you. Go ahead.
Yeah, see, I think the hybrid PPP model is certainly a much awaited move from the government. In fact, we would think that as a very significant stride that would happen to the sector. Not only that, about 40% of the project construction cost will be borne by the government, but one important trend that if we note in between the lines is when NHAI is going to bear 40% of the project costs, obviously there must be some kind of an approval mechanism by the NHAI on the project costs. So that we believe would stop the aggressive bidding procedure that has been going on in the sector till now. So that would kind of put a halt to the sector, because obviously then the project cost will have to be met. When 40% of the cost will have to be met by the government, obviously it means that the cost will have to be kind of agreeable to NHAI as well. So that would also, for example, the minister had also stated that some kind of a revenue sharing mechanism also will be there for poorly performing or where the traffic density is very low. If you notice, there could be a model in the road sector where there will be a regulated return as well. Like in airports and power, we could expect. I mean, it's too far-fetched hypothesis at this point in time, but slowly we would witness seeing the different kind of return model that will be envisaged through that. So that all, I thought I'll just add that to what Shiva had mentioned.
The next question is from Bexy Kuriakos. Any expectations from budget which can impact credit outlook for the infrastructure sector?
Yeah, the government had taken several measures. So I think first thing is what is critical for the smoothening of or ironing out the issues in the sector is to implement this in a much faster way so that existing problems can be kind of rooted out. The second most critical element is providing clearances on a timely manner, or I would say even before the project commences, or say even before the project goes for a pre-bidding stage, a substantial portion of the environment clearances stroke any other clearances which are required for the project, if it is available in place, that would shorten the time period. And also, many of the projects which are currently encountering, projects which broadly encounter challenges, the challenges encountered by the projects are broadly in this category especially. So hence that can be kind of avoided to a larger extent. And I think also if the government had been giving a substantial push to the renewable sector, so the implementation or enforcement of compliance as far as REC certificates are concerned, that would also add value, and preferential treatments for renewables also should add value. And if there are substantial revenue visibility as far as renewables are concerned, especially, then that would also should add value to the sector. And I think as far as roads are concerned, clearances has to be in place. Power, once this coal auction is complete, I think it should provide some breather to the existing power plants as well as for the upcoming power plants. So that is all from my side. Venkat has a few to add.
Thanks, Shiva. Apart from what Shiva had mentioned, we think that the taxation issues on the securitization deals, that would, the government gives a clarity on that, that would go a long way in improving the linkage between the capital markets and the infrastructure assets. And besides that, we also expect some, the government has already created IDFs and InvITs and those kind of instruments. But to trigger investments through that, through these medium is what we are looking at, the modalities for triggering investments into the sector. If you look at the market cap of most infra companies, they have certainly moved up over the last 1 year. So except maybe for 2 or 3. So we really believe that there is an investment sentiment, and we believe that this budget would capture those sentiments or would channelize those sentiments in a way that would benefit the sector in terms of capital flow. And we also believe that the government, the RBI is already indicating some kind of a different mechanism for funding infrastructure, the 525 scheme and the method of recognition of NPAs. I mean the relaxation, the temporary relaxation on recognize the the rescheduling, restructuring, etc. So we believe that the budget would definitely give clarity on the mechanics of different. I mean, we believe essentially that that there will be a different funding model for infrastructure, which obviously cannot be met with by short-term funding means, or where interest rate would be reset every year. So apart from that, we believe that there will be on the whole, we believe that there will be a long-term infra debt market that will be created. At least we believe that the budget will signal such a move.
And one additional point is there are some a couple of years back there were several regulators are being announced as far as coal and roads are concerned. Even if those regulators are formed and being given a under a statutory mechanism, statute, and if those regulators are being given powers to handle these sectors, that should add more stability as far as sectors are concerned.
The next question is from Mr. Firdaus Mantri. What is the outlook for wind power sector in Tamil Nadu given the transmission constraints and payment delays in past?
As a whole, we are on a stable outlook, and with our limited experience, and I would like Venkat to also chip in when after I complete. Specifically, what we have noted is in the last financial year at least, the DISCOM making payments to the renewables had been more or less streamlined to a larger extent compared to what was there earlier. This applies to Tamil Nadu as well. So I think given that and also the timely tariff order which has come in recently, should be the DISCOM should be in a position to streamline their further payments to the renewables as well. So the outlook as a whole, we don't have a state sector specific outlooks, but being said, we have a stable outlook as far as renewables are concerned.
I think the wind power in outlook would remain more or less as it is in the current year. The evacuation infrastructure is slowly improving, but we also have noticed higher PLFs that could have gone higher, but not so much translated into generation because of evacuation infrastructure. So we more or less believe that with the link that is happening in the southern grid, that could improve maybe in the second half of the calendar year. From a counterparty perspective, certainly I think there is I won't say marked improvement, but there have been good improvements in the receivables position as far as wind power is concerned, and the government also kind of recognizes the need for renewable energy. So we believe that there will be a mixed trend in the sector in the state, even though we don't have any state-specific outlook on wind power.
This question is from Mr. Vishal Sharma. Are you seeing a pickup in the volume of traffic? Most oil companies have reported excellent traffic figures for the December quarter. Therefore, in periods of low inflation, higher volumes are offsetting any decline in revenue. What is your opinion?
Yeah, we are seeing, this all comes from a broader perspective, which is the economy. We have revised our growth estimates, and we expect our Indian economy to perform at around 6.5 is the growth for the next financial year. And so from that angle, if we look at it, the industry should perform, and if the industries perform well, those cities or those towns which are connecting these two, the roads which are connecting these two industries or anywhere, any towns should perform gradually. We understand also that there are some improvements, say, as far as key roads which are connecting the high, industrial, two industrial towns or say larger cities. So those roads have performed well. But cities or say the roads which are connecting relatively a tier 3 city or a tier further down the line, those haven't performed well. On a larger perspective, if we compare this with the expectations which the management had, say 3-4 years back, this is not up to their expectations, and the underperformance which had been reported during the last few financial years is substantial, that you need to cover a lot of ground to come closer to their initial estimates. So that way, if we look at it, the recovery has to be strong in this financial year to cover up the last ground.
Yeah, actually, that's a good question. Certainly, there is improvement, especially in the last quarter, as regards traffic is concerned, but certainly not adequate to meet the management case expectations or the lenders' expectations that was originally factored into the lenders' model. But that is not. I mean, that is just one aspect of it. The most important aspect of the revenue is that the CPI, the WPI is actually going down. In fact, minus 0.39%. Because if you look at the last year's revenue, even though the traffic actually was, the traffic growth was negative during the last year, the high inflation rates, because these the toll rates of these roads are either partially or fully linked to inflation based on when the concession is signed. If you look at that, the increase in inflation rates kept the revenue moving at the rate of 3% or 4% or 5%. So, when I mean 3, 4, 5%, even when the inflation was at 7, 8, 9, it had offset the effect of negative growth in traffic. But currently, if you notice, the traffic increase is certainly not adequate to offset the effect of falling inflation. So therefore, we don't expect anything great in terms of revenue improvement, even though traffic could improve. We also expect traffic, as we mentioned in the outlook, we expect some marginal improvements in traffic, which is linked to the economy. But the revenue, we are very cautious on that.
And also, in the outlook we have captured another critical point is the moment of efficient, movement of the larger truck owners by LCVs migrating to a more efficient vehicles. So this should also should have some impact on the traffic if the truck owners are moving to a more efficient vehicle, which can provide them much higher capacity to carry a large cargoes or goods, then that may have an impact on the revenues as well. So migration from a less efficient to a more efficient vehicles will have an impact, and also the effect of sale of MAVs also will have an impact on the traffic.
All right, the question here is from Mr. Subramaniam Yadav. What impetus do we need from government for large-scale solar park to come up or to meet target of government under renewable energy? Also, there's another question from him, which is there any development taking place in REC sales?
No, REC, the enforcement has been poor. As far as the targets and numbers have listed in the presentation, the enforcement compliance has been very low. The target for FY13 is 0.45% and the compliance is just 0.08%. So if government starts enforcing this more stringently, then should have an impact. And as far as projects or impetus is concerned, I think the government, most of the state governments are coming out with state-specific solar policies. And of late, there are several states which have signed up with large companies as far as building up a solar parks are concerned. I think when this starts materializing, I think the power sector position, the power position will gradually improve. So there are several measures each of the states are specifically undertaking to give push to the renewables. When it starts materializing, it should have an impact. I think when the rest of the states also can capitalize on this, I think that should be the impetus which we are looking for. The rest of the states also embrace more solar friendly policies. I think that could be another incentive to the developers as
well. The question here is from Mr. Sivananda Subati. What is your outlook on merchant power tariff on a 5-year horizon? Also, if you can comment separately on southern region where north-south connectivity is expected.
Yeah. The outlook on merchant power, it is actually relative. We would like to think that it is going to be stable or where it is. The merchant power prices are in effect a combination of the demand and the willingness to, demand in terms of willingness to buy by the off takers. Vis-a-vis the merit order cost. If you look at the last few years, I mean, the last 2 years especially, it has more or less remained the same with cost of generation. With where it's a regulated return. If you compare the regulated return model, where there is an offtake agreement, long-term of PPA with state utilities, I think the merchant power plant has almost remained in tandem with that on the whole. But before that, we have seen merchant power prices behaving very ballistic, like 11 rupees, 12 rupees, or 9 rupees, and states were willing to buy because those were election years. So therefore, we saw a very high, that was also the intention of the government when most of the private developers went and developed these power plants. But now the situation is completely different. Coal is not available for merchant power plants. Coal will, and even if the merchant power plant wanted to import, has the ability to import coal and fire their plants, their offtake will remain limited. Now we expect that there will be some kind of a curve there by the state government also buying. In fact, it was all more or less informal. If you see the behavior of state government, they did not go for case one bids. Not much case one bids, except for say Tamil Nadu and maybe Uttar Pradesh. I don't know even the Uttar Pradesh bid went through. But if you look at the movements, not much case one was there. Therefore, the governments, the state distribution companies, they were quite cautious on entering the long-term deals. They entered only on a short-term or a medium-term basis with the offtake, with the generating utilities or the traders. So with that kind of a profile, we don't really believe that merchant prices will touch the highs of the last 4 years or 5 years. We believe that with the offtake constraints on one side and the coal constraints on the other side, we believe that merchant power will definitely support the shortfall and the deficit, but the prices are going to remain where it is. Especially, probably in states where elections will go through, maybe you could see some kind of a rise in merchant power, but I don't think it will be a very marked one. On the second question, Saranya, would you mind repeating?
Just 1 second, Venkat. Okay, it is if you can comment separately on southern region where north-south connectivity is expected.
Yeah, even in the southern, even in the south, I don't think there is. You see, if you see the deficit, it is actually coming down. So the deficit between the requirement and the supply, it is coming down. It may not reflect the exact deficit, but on paper, with all these load shedding and all those things, the deficit is coming down. So we don't really expect any major boost in merchant prices even in the southern corridor.
Okay, this leaves us with time to answer only one last question here. We have this one from Rashi Verma, which is, can you list some projects on PPP mode in next 1 year, highway power, etc.?
There are actually several projects on PPP which are being queued up. I would request, if he doesn't mind, he can look at it in the respective websites, because PPP India should capture many of these projects, and also the respective ministry would also come out with projects on the.
We believe more of these projects will become operational than actually.
Yeah, if if the other way of answering this question is what Venkat was trying to say is, we are expecting more projects to become operational rather than that would come up for bidding. There are some specific sites which he can, in case if he's referring to, he can look at for ports. There are Indian Ports Association will give the projects which are being lined up, and Ministry of Power should give, MNRE should also give some projects which are coming up, and then airports, there are it's being there with many of the newspapers as well as in the respective MOCA's website that there's a draft policy in place, and how they're going to handle the privatization of the 6 airports: Chennai, Kolkata, Ahmedabad, and also Lucknow, and several other states are being lined up. So that is.
All right, then that brings us to the end of this particular webinar. Thank you so much, Venkat and Siva, and thank you all for joining in and for your interesting questions. As you know, a copy of the report is available on our website. If you would require a copy of this presentation, I would request you to please mail us at investor.services@indiaratings.co.in. You could also follow us on LinkedIn, Twitter, or Facebook for regular updates on our upcoming webinars. And if there are any requests from your end for particular webinars, please let us know. We'll be glad to take that up. Again, thank you so much for joining. You have a great day ahead.
Thank you. Thanks, everyone.